My name is Chukwudibem Ezado, and I'll be holding your hand in the journey on how to invest in the stock market. Welcome to Module 1. Before we buy our first share, we will need to understand exactly what we are buying and the environment we are operating in. By the end of this module, this confusing jargon of the stock market will feel like a second language to you. See you in the next video. So here is the roadmap. We are not just going to define the terms, we are going to learn why these terms matter. We are going to also look at what a stock is, where these stocks are being traded, that's the exchange, and finally, we are going to look at how to read the numbers in the stock market. So see you guys in the next video. All right, let's start with the basics. When you buy a stock, you are not just gambling on a ticker symbol. Now, I will explain what a ticker symbol is in my next video. You are buying a piece of a real business. Think of a company like pizza. A share is just one slice of that pizza. If the pizza gets bigger, that's the company. If the company grows, your slice gets bigger. See you in my next video. So we're going to look at how companies raise capital. So there are different ways in which companies raise capital. The first one is either they raise capital by borrowing, and companies can borrow money, and when they borrow money, they have entered into debt. They can decide to sell ownership, which is called equity, sell some part of the business to the public. And there's another way in which companies can raise capital, which we call IPO. That's the initial public offering. The first time a private company sells stock to the what? To the public. Now you might be asking this question, why do companies go public? The first reason why a company go public is to pay off their debts, to fund expansion and research, and to allow early investors to cash out. And now I believe that you know that you are an early investor. So companies go public to allow you to what? To cash out. Now, why do companies sell shares in the first place? Usually it is because they want to grow without taking on a massive bank loan. They sell pieces of ownership to the public, that is we the individuals, in an event called an IPO. I've talked about that. We give them cash for expansion. They give us a chance to profit from their growth. So this is how a company raises what? Capital. I'll see you in my next video. All right, so we are going to talk about stock exchange. What is an exchange? An exchange is a regulated marketplace where buyers and sellers meet. Now we have major global stock exchange. We have the New York Stock Exchange, which is the world largest exchange. We have the NASDAQ, is also in New York. We have the London Stock Exchange. And we also have the Nigerian Stock Exchange. Just imagine this. If you want to buy something like tomato, you have to go to a grocery shop, right? If you want to buy stocks, you go to an exchange. We have giants like the New York Stock Exchange in New York, but we also have our local powerhouse, the Nigerian Exchange Group. It was Nigerian Stock Exchange, but it has been changed to Nigerian Exchange Group. See you in my next video. So we are going to look at the key differences between the local market and the foreign market. The number one difference we have here is the currency. No, it's not the same currency that you use to transact in the local market that you use in the foreign market. So when we talk about the local market, we're talking about the Nigerian market, right? So we use the naira to transact in the local market, and we use dollar and pound to transact in the foreign market. Then the second difference we're going to look at is the risks involved. The exchange rate fluctuation affects return, right? So the two markets have what we call fluctuations. Now, it is better that you earn in foreign markets. It would give you what more return when you exchange the foreign currency into your local currency. That's why we say that it's a difference between the local market and the foreign market. Then we have volatility. Emerging markets like Nigeria can be more volatile than developed markets. Now, when we talk about volatility, what we mean is the rising and falling. So the market is not stable. It goes up today, tomorrow it comes down. And we experience more volatility in the local market, which is the Nigerian market. Then we also have access. So the foreign market offers access to global tech giants like Amazon, Tesla, and the rest of them. Then the local market offers investment in familiar and tangible companies like Dangote, the MTN Nigeria. And also another difference is the regulation and the number of hours in which you trade dates or you buy your shares. Now there are differences in the timing when the market is open and when the market is closed. I'm still going to talk about it in my next video. This is a crucial strategy. In investing in Nigeria, it means that you'll be earning in what? In naira. So when you invest in the Nigerian or in the local market, that means your returns, if you are being paid dividend, it will be in what? In naira. And it is great for people that do their transactions in naira, right? But subject to inflation. Now, the Nigerian currency is subject to inflation. That's why it's advisable. I advise most of my clients to invest in the what? In the foreign market. Because when you receive a dividend or when your stock grows, you have to convert that foreign currency into what? Into your Nigerian currency, thereby making you to even earn more. But when you invest in, I'm not saying investing in the Nigerian stock market is bad. People make a lot of money. As a matter of fact, there's this friend of mine that made almost 26 million naira this year in investing in Nigerian market, right? So people make a lot of money, but to avoid that volatility, it is advisable that you invest in what? In the foreign market. Now, there's also what we call devaluation. So investing abroad allows you to hedge against currency devaluation by holding assets in dollars, but you must deal with international regulations. A balanced portfolio often considers both. If you invest in the foreign market, you have to, there's an obstacle that you must put into consideration. That's the international regulations. I'm still going to teach you guys about that. But it is advisable that if you are investing in the local market, don't just invest in the local market, also invest in the foreign market. I'll see you guys in my next video. All right, so we're going to look at the basics, speaking the stock exchange language, right? So we're going to look at what shares is. We already know what share is, right? We say it is the unit of stock you hold. And there's what we call a ticker symbol. I promised you guys that I will be explaining what a ticker symbol is. So we say that a ticker symbol is a unique abbreviation for a company. Company like Tesla, we all know Tesla, right? So the ticker symbol for Tesla is TSLA. So a ticker symbol is a symbol that is used to identify a company in the stock exchange market. That's what a ticker symbol is. So any company that you're looking for in the stock exchange market, you just need to type the ticker symbol or you type the name of the company, the ticker symbol will appear. Now we're also going to talk about dividend. We say that dividend is a portion of a company's profit paid directly to the shareholders. Now, it's not all companies that pay dividends. We have two type of stocks or shares. We have the dividend paying stocks and we have the capital or the growth stocks. Now, for the dividend paying stocks, these are companies that share a fixed percentage of their profits with their shareholders. While the non-dividend stocks, the non-dividend paying stocks, are companies that reinvest their profits to enable their company grow. Now, most companies that makes up this high growth stock are tech companies. We have biotech companies, we have AI companies, and the rest of them. Now, let's decode this terminology very well. A ticker is just a company's nickname, right? We just see it as a company's nickname on the exchange. So, what you use to identify a company on the exchange is what we call the ticker symbol. But my favorite terminology in this slide is dividend. When it comes to making money, that's when my ear becomes sharp, right? So when we talk about the dividend, we said it's essentially a company telling you thank you for giving them your money to expand their business, for giving them your money to grow. So when they make profit out of your money, the money they have collected from you to make the business grow, they give you a fixed percentage from that profit. That's what we call the dividend. And when they give you that fixed rate, everybody's happy. So that's really the importance of what investing in the stock market. I will see you guys in our next video. This video we'll be looking at valuation. How do you know the size of a company? First of all, we're going to talk about market capitalization, or in short, you can call it market cap. This is the total value of a company. And if you want to calculate your market cap, you use the current share price over the number of what? Of share. Then we also have what we call the PE ratio, that's the price to earning ratio. How much are you paying for $1 of the company's earning? That's PE ratio, price to earning ratio. It is used to determine if the stock is expensive or if it is cheap. How do you know if a company is big? Now, the way to know if a company is big, you're going to look at what? Their market cap. There are some companies that their market cap are in billions of dollars, some are in millions of dollars, some are in thousands of dollars. So the market cap is what determines how big a company is. How do you know if a stock is overpriced? You look at the PE ratio. And I told you guys that the PE ratio is the price to what? To earning ratio. We'll go deeper into this concept of PE ratio in our later videos. But for now, just know that it helps us to compare the price of stock relative to the money the company actually what makes. So the PE ratio helps us to weigh the price of stock, right, relative to the amount of money a company makes. I will see you guys in the next video. In this video, we'll be looking at the types of stocks. Now, I would like you to note something. Not all stocks are equal, right? So stocks are categorized into two. We have stocks based on ownership rights and stocks based on investment style. Now, when we talk about stocks based on ownership rights, they are divided into two. We have the common stocks and the preferred stocks. The common stock represents ownership in a company with voting rights and potential for dividend payment. That's what the common stock is all about. Then for the preferred stock, we said it has priority over common stocks in dividend payment and asset distribution. But typically in this type of stock, which is the preferred stock, there is no what voting right. So you don't have the right to vote when you buy a preferred stock. Then under the investment style, we said that the stocks are divided into two. We have the growth stocks and we have the value stocks. Then in the growth stock, we said companies expected to grow rapidly. These are the companies that are found in the growth stocks. So most of the times, what they do is that they often reinvest their earnings rather than pay dividends. So growth stocks, companies that are in the growth stocks, they don't what? They don't pay dividend. What they do is that they reinvest their profits. And I told you guys initially before now that we have companies that are in the tech examples. We have Tesla, Amazon, and the rest of them. Then the value stocks. So the value stocks, these are undervalued company with potential for long-term growth, often traded at a lower price to earning ratio. We discussed lower price to earning ratio, and I told you guys that lower price to earning ratio is used to measure an overpriced stocks or an undervalued stock. So this value stock, we said it is often used in trading at a lower price to earning what? At a lower price to earning ratio. Then under the investments that we have other types of stocks. We have income stocks, established companies with a history of paying consistent dividend, of offering regular what? Income. So this one are called the income stocks. We have the dividend stocks and the rest of them. So this is where we'll be stopping in this video. See you guys in my next video. We'll be looking at how to read a stock quote. How to read a stock quote. Now, when you go to your, or when you enter your brokerage account, there are a lot of data you need to learn how to what? To read, and you need to know what the informations that are written on the dashboard of your brokerage account. But before that, let's just look at what we have here. So we have the price. The price of a stock is the current trading value of what? A particular stock. Now we have the open price and the previous close. Now the price at the start of the day is the what we call the open price, right? When the market opened, the price that appeared when the market opened, that's the price at the start of the day. Then the previous close is the price that the market closed with the previous day. Let's say today is Tuesday. The previous close should be the current price of the stock in the market as at when the stock market closed yesterday, while the open price is the current price of the stock when the market opened today, which is on Tuesday. Then we have the high and the low. Now, when we talk about the high, the highest and the lowest price that the stock price have reached today, right? That's the high and the low. Then we have the volume. The volume talks about how many shares have changed hands. How many shares have changed hands? It gives you a glimpse of the activity level, how people trade a particular stock. Now we also have change percentage, how much the price have moved since the market opened. Let's say that the price of a stock went up by 0.2%. It will show you, or you can from your dashboard you can see that the price of a stock went down. So the percentage change is showing you how many percent change the price of a stock moves in the market in a particular day. So when you open your brokerage app, you will see a screen full of numbers. You don't need to panic, right? Just need to calm down and look at this data, and you'll be able to interpret it. You look for the volume to see if people are actually trading the stock. You look at the percentage change to see the momentum. This quote is your dashboard for making decisions. So you cannot make decisions until you're able to look at your stock quote, where we have a little bit of information about what is going on in the market. I think this is the last slide or the last video for this module. I want to thank you so much for staying to this last video. I'll see you in module 2.